Welcome to LevFin Insights podcast series, Levered Lines. I'm Luke Miller, Global Editor-in-Chief at LevFin Insights. I invite you to listen to our series of podcasts where we interview key market participants as we look across the main themes impacting the leveraged finance markets. And with that, over to the team.
Welcome to LevFin Insights Levered Line podcast. I'm Steve Miller, a member of the CreditSights team here at Fitch Solutions. Today we're talking to Chris Wood. Chris is an accomplished business builder in our space. After a long and successful run at Truist and its predecessor SunTrust, Chris joined Huntington Bank last year to lead its capital markets and sponsor coverage. Chris got his start in the market at Bank of America. Outside of his day job, Chris serves on several boards, including his alma mater, the University of Rochester. Finally, Chris is a most valued friend of the family here at Fitch and a fun golf partner. Chris, thanks for joining us today.
Steve, thank you for having me. Always great to be with you.
So let's start with a table setter. Can you give us an update on your business and how you aspire to grow it?
Huntington, at that point, was $200 billion in assets.
Wow.
And they were underweight capital markets compared to some of their peers. The reason they reached out to me is because of my experience at Nations Bank, which became B of A, and then SunTrust, which became Truist. And they, I'd seen that movie before, and they wanted to repeat that. So, long story short, in Thanksgiving of 24, I resigned, took my garden leave, and started last March, at which point I started recruiting for three primary businesses. First, investment grade, found someone to lead that business, really changed the profile of the bank. We've seen I'll give you a full update on that, but we've seen a nice uptick on that. Second was equity capital markets, looking at what was a very small platform. How could we grow it profitably, yet serve our clients meaningfully? So we started to put that in motion. And then really what they were most interested in is looking at leverage finance.
Yes.
They had a small syndications business. It was mostly a pro rata business, very small companies. So I brought on a team that has embraced that, and we're seeing a big change. The final piece of the puzzle was really building a sponsor strategy. Prior to myself and the team joining, they were working with very small cap type sponsors, more regionally focused. And so what I came on to do is to say, look, let's come up with sponsors where we have conviction about what they're investing in that match up well to what we know, where we're good at, and that we know how they behave when times get tough. And so we've effectively done that. So fast forward to today, hired 40-ish people in addition to what there was there. And we're off to the races, right? We've moved up significantly in the league tables. We started from a very low or high place, depending on how you look at it. And we're moving up nicely. But more importantly, the conversation with our clients has changed. We are adding value to the conversation. We always talk about amongst our teams. We want to go in with valuable ideas that allow our clients to grow profitably, successfully, utilize the markets. And prior to that, Huntington was primarily a lender. And they did a good job. They've grown. Fast forward to this year, and just this past weekend, we integrated the Cadence acquisition. Huntington is now the 9th largest commercial bank in the country. Almost they're approaching $300 billion. I think we'll be $290 at some point here, and then $290 billion in assets in the next couple months. So, my job is to build the plumbing so that we could visit with more clients, spend more time with clients, drive ideas through a verticalized model where, whether it's our TMT team through data centers, our healthcare team doing long-term facilities all the way to products and services. Our FIG team is excellent. So we've now hired the bankers. We're continuing to hire them, but we bring ideas to our clients and really try to help them think about the world in an environment, as you and I were talking about a little bit earlier, where there's a lot of geopolitical events going on and a lot of potentially tricky financial situations.
Given that, it's interesting. I mean, this has been a year that I like to describe as running the full gamut of the three little bears, right? You had started too hot, then it got too cold for a while, then seemed just right, then hot, now a little colder again. How do you scale things as they look today, and what's your outlook on for trends like M&A and tone in the market?
Yeah, so that's a great question, Steve. What I would tell you is first looking at the Huntington business, right? We had to change the way our bankers were thinking about the products and ideas we were delivering. So we've done that. And in an environment where, and I'll come back to M&A and talk about it, an environment where M&A isn't entirely relevant to us, I will touch on where it is. We've grown, and we've grown substantially. So that's great. Now, as we talk to private equity, everyone says, what's going on with private equity?
Right.
What are the challenges they're facing, right? And we've all heard them. It's a mix of their valuations are probably lower today than they were a few years ago due to the cost of capital.
Yes.
Due to an inability to sell because of those valuations being lower, due to the conversation they're having with their LPs of their LPs wanting some return of capital. So it's gotten more complex for them. We thought last year the markets would open up.
Yeah.
Then we had the great tariff debate, or whatever you want to call that period. That set the whole market back. And then this year, we once again, I think a lot of us thought, okay, this is going to be the quarter
Right.
where the markets open up. And we had a little situation pop up in Iran.
Right.
So we're, with all that, we're all dealing with what we can. But we've stayed busy. We're working with the folks that want to use the Pro Rata Market. Very, very active there. We just in this last month we've led several transactions that were well oversubscribed, which we'll talk a little bit about what's going on with the bank Pro Rata
Yes.
market. But we've seen that. The other thing that Huntington has, and part of the way I've set up my business is we cover two basic segments. One is the corporate segment. And let's just say that's companies 500 million, some public and larger. And that's the business that you probably hear about the most. But we also have a middle market segment that's going to be founder-owned companies that are less than 500 million. And to serve them, I've got a team dedicated to them, does small pro rata deals primarily. We also bought about 4 years ago an M&A boutique called Capstone, and they've stayed very active with founder-owned businesses. So much so that at the end of last year, we bought out of KKR, Janney, Montgomery, Scott, a number of their trading businesses. I added to our equity capital markets and equities business out of them. We now have a full service equities business. We got also a advisory business called TM, which we're integrating into Capstone. So we're finding different ways, different levers to pull with our clients to try to serve them.
When you think about the founder space, it's interesting. We don't necessarily talk about that as much as we should in our services. What are those founders generally looking for from the leverage finance market?
So the first thing we talk about when we meet with these founder-owned businesses is we like to ask them, what is your growth plan? Are you first generation, second generation? Do you want another generation to come in and take over? So we first talk about, where do you want to go? Are you looking to grow the business, or are you looking to prepare it to potentially sell or merge with another business? So we have that conversation. Once we understand that, if they're looking to grow, that's where Capstone and my teams can work closely together. We can present ideas and then help them finance them. Again, most of that type of financing is going to be made up of pro rata lending from the banks, or in some cases, we also have a small debt advisory business that can bring in direct lenders that want to do these smaller deals. So that's the type of, but you're talking about leverage multiples of anywhere from 2.5 to 4 times probably as a max.
Very low, yeah.
Yeah.
And so let's talk about the pro rata market. You've alluded to it. It's a market that, in our businesses, we don't necessarily cover as closely as we do the institutional market. Can you give us the broad context of how that market looks, what's the tone there, how people are pricing credit, that sort of thing?
Let me start with what's going on with regional banks, right?
Mm-hmm.
You've seen Huntington. We've been active. We bought Veritex last year, and then later that year we bought Cadence. And as I said, we just finished integrating them this past weekend. So if you go to Texas or Florida or Alabama and you look at the Cadence signs, they were all converted to Huntington this weekend. So that's on the retail side of the bank. But all of our systems, everything was fully converted this past weekend. But we're not the only ones out there, right? Pinnacle and Synovus merged. Fifth Third bought Comerica. PNC bought a business out in Colorado. So
Interesting. Okay.
banks are growing. It's a very favorable regulatory environment, made a little more complicated over the last couple of months. Having said that, though, all of these banks are looking to to grow deposits and grow loans.
Mm-hmm.
One of the easiest ways to grow their loans outstanding is to entertain their corporate clients to do transactions with them in the pro rata market.
Yes.
So, as I said, our syndications team is constantly talking to all of these banks, and the demand is outstanding. We've even heard anecdotally, where a couple years ago, a bank that was Southeast-based or Florida-based might not want to go outside of their geography. Some of these banks are going well outside of their geography. They're following some of their sponsor clients. They're following some of their corporate clients, despite what they had previously done. So we've seen no issues in bringing deals to market and getting great demand from all the banks.
Is there so when I think about the institutional market, term loan B, whatever we want to call it, single B paper, feels like the range this year is kind of in that 350, 375 spread, and call it like 98 if the market's struggling, or 99.5 if it's hot. What do you see as kind of the pricing parameters, broadly speaking? Obviously, we're not talking about any specific deal in pro rata land.
Pro rata is going to range L225 on the very tight end. It probably doesn't go much beyond SOFR plus 350, 375, for what they're trying to do. What we find, ironically, is some of our credit teams start to get a little spooked if we price something above that, even though it might make sense. But the other thing that we're seeing happening with sponsors and corporate clients is the direct lender market, right?
Yes.
That's gotten a little trickier between the marks and some of these direct lender private credit firms facing redemptions. I think they're, in some cases, taking a little bit of pause, slowing down some of their activity, raising more cash just to be ready for these redemptions. So that's probably reintroduced the pro rata market for some of us, as well as some term loan B refinancing. So you see this, Steve, but if you look at the activity, it's largely driven by repricings, refinancings, and some dividend recaps. There's not a lot of M&A, fortunately or unfortunately, I don't know. So the demand's there generally in all these markets, but it is evolving a little bit. And some of the things that made the direct lender model attractive maybe are becoming a little less attractive. One, the gap in pricing, as you alluded to, it could be advantageous to refinance some of those deals in either the term loan B or the pro rata market, depending on the leverage point and what their ultimate goals are. I think there is an open question, not in many of these cases, right, of the larger firms are going to be here, but what happens to some of the smaller firms? Do they merge with someone or in some cases have trouble raising their next fund?
Yeah, that's a fair point. And with the banks, there are still so many of them out there who are playing in the space. So let's switch gears a bit. I mentioned in the intro that you've been an accomplished business builder in our space. This is not the first time you've done this. If you compare the effort you've put in over the last year and a half to build out Huntington versus what you saw in your past iteration and whatever, how have things gotten easier? Have they gotten harder in some ways? How do you scale it?
Well, my first go around was at Nations Bank when we were talking about this earlier, Steve, right? In '95, and they acquired Bank America, became
Yes.
Bank of America in '98. And that was a time of high growth, right? Lots of M&A activity in the bank sector. Nations Bank grew very, very quickly and grew the high yield market very quickly.
Yes.
And that's where I started, really. And there was a focus on that, and there was kind of a level playing field for new entrants. So we were able to take market share very, very quickly back then. You fast forward, I then joined SunTrust. We thought a number of us had joined from Bank of America, and we thought the growth would be similar to Nations Bank, acquisitive driven. It wasn't. The regulatory environment wasn't there. The prices weren't there. So we grew organically. So that was a whole different game that we played, and it was one of recruiting and building. Whereas with our prior thing, you could literally transfer teams over and grow very, very quickly. So very different perspectives, both a lot of fun, both great firms. I think what's changed today is it's the direct lender market, the private credit is providing an alternative to companies. So some things are harder. So building a high yield business today, I think, is substantially harder. We're in the business. We attend to our clients. We talk about high yield, but the reality is that the left lead activity is dominated by kind of 3 to 5 firms, if you want to put it out there. So that's how I'm thinking about staffing that business is different than I would have thought about 10 years ago and 20 years ago. We also, in my current role, I have to think about all the markets, right? How do we grow our investment grade businesses? How do I grow our equity capital markets business? So personally, that's a little different for me. I was always a leveraged finance banker. The key is that we can offer, again, the same. We try to set up our teams, set up the pitching mechanics, the way we think about businesses, the way we think about M&A. We try to think about that all the same. We're just finding different asset classes to help them finance it. So I think those are the key differences out there, Steve. The talent pool just is great out there. So in terms of recruiting folks, from the day I started, even before probably, I got a number of phone calls from folks that really like the idea of building a business. So everyone that has come over and joined us really embraces the idea of building a business. It's, one of the arguments we make, I think it's true, is that it's more fun to grow market share than to stabilize or shrink market share. So everyone likes that business. And all of us have brought relationships over from our prior institutions, and we work well with our prior institutions too. So we compete, but we also work together. And the reality is we get to better outcomes for our clients because we can all talk and kind of figure out the right strategy for folks.
It's interesting. I guess that's always been true about the syndication business, that people collaborate, they compete, but in the end of the day, you've got to go on and do deals.
Yeah, that's right.
Yeah. So staying on that topic and maybe a slightly different angle, and we talked a little bit about this before, how are you seeing technology, AI, LLMs, whatever you want to call it, have an influence on how you do your business and how in particular, your young associates are doing it?
Yeah, it's affecting every part of our business. We have grown our CIB analyst program, and so we're getting these great young people in college who come to us their junior year, and they intern for us, and then we try to convert them to full-time offers the next year. The job of, I mean, it starts everywhere. The job of an analyst is changed. When you and I grew up in the business, an analyst might go to the printing press and spend the night there going over the typos in the OM and in between shooting pool while they do the corrections and things like that. We also produce pitch books, right? A lot of that has changed with technology. You don't produce an OM. You have no need to go to a printing shop. The pitch books, you have you have centers that produce all that stuff for you. So we're actually asking our analysts right from the get-go to be much more thoughtful. Then you introduce all the new tools, Copilot, Claude, whatever the firm may be using. And we've facilitated that for all of our teams in capital markets. And we encourage folks to use it. So we've talked about some of these, I think the most successful analysts come in and embrace AI, figure out how to use it as a tool and really make their job better. And the best analysts, this has been true for the whole length of investment banking. The best analysts are those who somehow preempt the next question, right? So that can figure out, okay, I'm looking at this company. What if I go down this hole or that hole, and kind of try to ask a few more questions? So we're actually, the work that used to take 3 or 4 days can now be done, in an hour by an analyst getting on and basically pulling information off the various sources, using Bloomberg, using Fitch, using all these products that we have and integrating them. So we're taking the next step, and as I believe all of our peers are, which is our CRM systems are all integrated now. We're building dashboards that predict or preempt what our clients' needs may have, right? And a lot of this is driven off of public information, but then we drive what our CRM systems have, and together we can pretty quickly determine what valuations are. Have they changed in the last month or two? So that changes how we go to our clients and talk about potential activity for them. So we're trying to embrace it as quickly as we can and as responsibly as we can. We obviously want to make sure that we use it as a tool. We're not replacing it for the human element. But Huntington's been great about that. It's we've got teams dedicated to it, and we're moving, like I said, as quickly and as responsibly as we can to really make it a part of our everyday life. We've encouraged everyone to everything from even HR tasks, right? Doing a review and using some of those tools to help you give better coaching to your colleagues. Trips, using all of our tools available to us to how do we manage our expenses better? How do we manage our use of hotels? And so we're looking at every part of our business and really trying to ensure that we're maximizing what these tools can offer us.
It's so interesting. And I've been thinking about this lately, how when we were young, the power move was to not have to use the mouse in Excel, just use the hotkeys. Now the power move seems to be don't even use Excel at all. Just have Claude build it for you and turn the model out.
Yeah. You and I were talking earlier. I mean, you can go to Bloomberg or to Claude and pretty quickly, and is it 100% correct? Probably not. But you can pretty quickly get to a base model, as you're saying, to run an LBO analysis. And it does a pretty good job.
Incredible.
Yeah.
So staying just on that topic, and maybe you've answered this already, but if you think about young people like our sons who are coming up now in the business, like what advice do you give them as far as skill building and all that to try and be successful for the next X number of years?
Yeah. So I've told my sons, their friends, analysts, interns in our program, stay focused. There's a lot of change going on out there. I think for a few years, the markets broadly rewarded people for switching jobs. I go back to some of what you and I learned growing
Mhm.
up. It takes a certain number of hours to become good at something.
Yes, that's for
So
sure.
switching jobs every 3 months might be the right thing in a technology focused business, but for providing client advice, that it could accelerate it, but more likely than not, you have to relearn a lot of things and
Yes.
revisit them. So I tell everyone that I still believe any investment banking training program is the best way to spend 2 or 2.5 years.
Mhm.
You come out of there and you can stay in banking, you can go to consulting, you can go to a business development role at a corporate position. I've had people over the years start businesses. I had a couple guys. One started a vineyard in South
Mm.
Africa, and another one started a water refining plant in Africa. So
That's so
you come
interesting.
away with
Yeah.
skills of knowing how to analyze businesses, how to look at cash flows, how to interact with leaders of businesses, and then how to present all that stuff. Right? Those are all valuable skills that, whether you stay in banking or not, will help you. So embrace AI. Stick with it for a while. It's hard.
Yes.
We still ask probably way too much from some of our analysts in terms of hours, but
Mm.
as long as you have the right platform and you're providing the right training for them, what they take away from the business is very valuable. Some of them end up loving banking and stay in it for much longer time. Some of it move on, but the training that they get is worthwhile.
Yeah, it makes a lot of sense. So finally, let's turn to something a little off topic, which is, as I mentioned before, you serve on several nonprofit boards. Any observations, things you've taken away from doing that work that'd be worth sharing?
So, probably where I'm most active now with this move to Huntington is with the University of Rochester. I
Mm.
sit on the Arts and Science National Council, which helps advise the Board of Trustees on a lot of their decision making. Currently, we're doing a capital campaign, so I'm helping out on that.
Mm.
But what got me interested in that is, Rochester is where I went to school. It wouldn't have been. I think I was probably sold a bill of goods on the weather there.
Yeah.
I never expected it to be quite as cold as it was, but I loved every minute of it. I
Mm.
love I'm still in daily contact with all of my friends from college. There's a group of us that get together, and but more than that, I love the kind of their commitment to research and what they did. I started out as an engineer,
Mm.
ended up as a political science and economics student, and in both cases they were state of the art. Right?
Mm.
They in engineering, Rochester was one of several schools that developed optical fiber, which is the foundation
Oh,
for
right.
how the internet is delivered to everybody's home today. Um, they had a laser. I think one of two lasers in this country that has enough power to create another planet, basically.
Oh my.
I mean, it's a microburst, but
Sure. Yeah.
the government, I think, reaches out to them and uses them for testing certain things, and so it's really cool how committed they are to research. In economics, they do a lot of the same things. When I was there in political science, they had a number of professors who were incredibly active with elections at the time, and so it was just a fascinating place to be. So I got involved here, and it's honestly, I look forward to these meetings because they always bring in professors and actually have a session on something that is fascinating. So I get to give back a little bit and help them, but what they give me is still much greater than what I'm taking away from it. So I really enjoy it. I enjoy the people, and I think going back a little bit to the AI topic, I think for all universities, it's a little bit of a competitive race out there to what you can provide students, because the AI is going to change the world, right? It's going to eliminate probably or reduce the need for certain jobs. It's going to change how some jobs occur, right? I mean, if we go back to software, it all ties in together.
Yes.
If we go back to software evaluations, they've been impacted this year because you can use AI to replace some of the code writing that's been done by kids coming out of school, young people coming out of school. So that's changing the equation. So I think universities, colleges are going to have to continue refining what they deliver, how they deliver it, to make sure it's of value, because it's gotten very expensive in many cases, right? So paying for a lot of these private universities, paying $70,000, $80,000, $100,000 a year, in terms of the affordable things, may get more and more challenging. So I like to, when we get together, we debate, what can we do to make this program, this university, more valuable. And, they're doing it every day. They're fighting out there.
That's fantastic. Well, good for you. Well, let's leave it there. Chris, thank you for your time, your insights today. Please catch us next time for another discussion of loan market topics.
This podcast should not be copied, distributed, or reproduced in whole or in part. Neither LevFin Insights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. LevFin Insights is not providing investment, legal, accounting, or tax advice. LevFin Insights is not providing research or making any recommendations, nor is LevFin Insights offering or soliciting any transaction with respect to the purchase or sale of any security that the listener may hold.